Okay, let's put on our value investing hats for a second and dive into an absolute classic financial mystery. Welcome to today's Explainer, where we're going to use a strict Warren Buffett-style lens to dissect the fascinating paradox of HP Inc. You probably have an HP product sitting on your desk right now, right? But beneath the surface of this incredibly well-known household name lies one of the most perplexing financial profiles in the market today. We have to figure out, is this a classic value trap waiting to catch unsuspecting investors, or is it a hidden gem just hiding in plain sight? Let's get right into the numbers.
To crack this case, we'll systematically break down the data into 5 core areas: the valuation setup, the red flags around stalled growth, the cash flow bright side, capital returns, and finally, our fair value verdict.
All right, part 1, the valuation mystery setup. This is the absolute fundamental question we have to answer when weighing the conflicting data we're about to see. On one hand, you've got a legacy hardware business operating in a world that's entirely shifting to cloud and mobile. It's so easy to just label them a tech dinosaur and move on. But, on the other hand, the financial metrics reveal a company that is aggressively printing cash. So which narrative is actually driving the stock?
But what's really wild here is this incredibly low PE ratio, which makes HP look remarkably cheap right out of the gate. A price-to-earnings ratio of 8.05 is virtually unheard of in the modern tech sector. And to add to that, the forward PE ratio is even lower at 7.30, and they're trading at a price-to-sales ratio of just 0.35. By traditional valuation multiples, Mr. Market is pricing HP as if it's going out of business tomorrow. But here's the paradox we have to investigate. We have these dirt-cheap valuation multiples right up against fundamentally stagnant growth. Yes, you're paying literal pennies on the dollar for their sales, but look at the growth metrics. The 5-year compound annual growth rate for revenue is negative 0.50%. The top line is slowly shrinking. This is the exact tension that defines a potential value trap. You know, a stock that's cheap, but cheap for a very good reason.
Let's move to part 2 and examine those red flags a bit closer, specifically the stalled growth.
So, the really crucial point here is the consistently negative long-term trend in both revenue and net income. It's a glaring signal of top-line struggles. Over a 3-year period, revenue hasn't just stalled, it's actually shrunk by almost 2% annually. Over 5 years, net income has contracted by almost 5% per year. When your core business is selling PCs and printers and broader market saturation hits, well, this is the painful reality that shows up on the income statement. Now, if you're just skimming the balance sheet, you might panic at these massive negative ratios, but actually this brilliantly illustrates a common quirk of aggressive buybacks rather than pure financial distress. If you ran a standard stock screener, a price-to-book ratio of negative 25 and a debt-to-equity ratio of negative 12 would look terrifying. But what's really happening? HP has been buying back their own stocks so aggressively over the years that it creates a massive treasury stock deficit on the balance sheet, turning total equity negative. It's a classic accounting anomaly in mature, cash-rich tech companies, a sign of very owner-oriented management, not a sign that they're insolvent.
However, and this is a real caution sign, their current ratio is 0.76. That means liquidity is undeniably tight in the short term. A current ratio below 1.0 means the company's short-term liabilities actually exceed its short-term assets. Adding to this, their quick ratio sits at just 0.46. Basically, if HP had to pay off all its immediate bills tomorrow without selling any inventory, it would seriously struggle. They are running this business incredibly lean, maybe just a bit too lean for comfort.
Okay, let's switch gears to part 3, the bright side, and uncover the cash flow engines keeping this thing running.
Just look at this massive free cash flow yield of 14.65%. This is the exact kind of metric Warren Buffett loves, showing they generate incredible cash relative to their valuation. To put this into perspective, for every $100 you invest in HP stock at current prices, the underlying business is generating nearly $15 in pure, unadulterated free cash flow every single year. In a market where a lot of tech high flyers struggled to generate any free cash flow at all, HP is practically a printing press. And the data confirms that their actual cash generation even outpaces their accounting earnings yield, which is a massive hallmark of high earnings quality. Listen, earnings can be manipulated with depreciation schedules and clever accounting adjustments, but cash is reality. The fact that their free cash flow yield of 14.65% is significantly higher than their earnings yield of 12.77% proves that their profits are real, tangible, and actively hitting the bank account.
And this beautifully highlights that despite those stalled revenues we talked about, management is still highly efficient at allocating capital to generate returns.
An 18.64% return on invested capital is just fantastic. It means that for every dollar of capital management deploys back into the business, they're generating an 18-cent return. So while the overall pie isn't growing much, the efficiency with which they operate the business they do have is top tier.
Moving on to part 4, let's see how they share all that cash with investors through dividends and capital returns.
Honestly, this setup is an income investor's dream. It shows a high, incredibly safe yield that has been growing for a decade and a half. You're getting paid a hefty 5.64% dividend yield literally just to wait. But more importantly, look at that payout ratio, just 43.82%. That means they're using less than half of their earnings to cover this massive dividend, leaving plenty of room for error, debt repayment, or even more stock buybacks. And with 15 consecutive years of increases, management has deeply proven their commitment to shareholders. Now, while the dividend growth rate has definitely been slowing down in recent years, the overall commitment to returning capital remains rock solid. If you look at the 5-year average, they were hiking the dividend by over 9% a year. More recently, in the trailing 12 months, that increase has cooled off to around 3.6%. Honestly, this makes sense given the top-line stagnation we discussed earlier. You just can't grow the dividend at 9% forever without actual revenue growth. But still, a highly secure growing 5.6% yield is a massive tailwind for your total return.
Okay, let's dive into our final section, part 5, and bring all these clues together for our fair value verdict.
Let's see how this all builds a compelling case. Based purely on discounted cash flows, the calculated fair value sits dramatically higher than the current $21 trading price. The data models show a fair value based on free cash flow at $42.19. Even if you want to be more conservative and use an earnings per share model, the fair value still sits up at $36.89. Meanwhile, the market is pricing HP at just over $21. There is a huge disconnect here between the mathematical value of the cash being produced and the price the stock market is actually willing to pay.
And this brings us to the ultimate value investor metric, a staggering nearly 50% margin of safety. According to the free cash flow models, you're essentially buying this asset at half off its intrinsic value. A margin of safety this large acts as a massive cushion for your portfolio. Even if management makes mistakes, or if PC sales decline a bit faster than expected, having a 50% buffer goes a long way in protecting your principal investment. So I want to leave you with this final thought. In the end, you have to decide if the incredible price completely offsets the lack of growth. You're looking at a business with essentially negative growth trends, tight short-term liquidity, and negative equity on the books. But in exchange, you're being offered a massive 15% free cash flow yield, a highly secure 5.6% dividend, and a 50% margin of safety on the purchase price. So is HP a value trap slowly fading into irrelevance, or is it one of the most brilliant cash cow investments available in the market today? The data is all on the table, and the verdict is yours to make. Thank you for joining me for this explainer, and keep questioning the numbers.